Mezzanine debt can be sandwiched between other financing tools like senior debt and preferred equity. It can also invite other businesses and private equity funds to provide financing capital for real estate investments. Mezzanine debt is a bridge financing option that gives a lender the right to convert to an ownership or equity interest in the investment opportunity if the loan is not paid back in time or in full. It differs from private equity in the sense that mezzanine debt requires a pledge of equity. Depending on the commercial real estate project, mezzanine debt can offer flexibility and enhanced overall return potential to the borrower, while offering an attractive rate of return to mezzanine debt investors over a relatively short period. Mezzanine debt is a hybrid lending vehicle, commonly used in real estate developers to secure supplementary financing. For this reason, it's also referred to as mezzanine financing. It's a flexible financing tool that can help all types of borrowers finance real estate investments. Generally, it's subordinated to debt provided by senior lenders, such as traditional banks. Mezzanine debt gets its name from the mid-level placement it has in the capital stack, much like how a mezzanine terrace is sandwiched between two floors. Notably, mezzanine debt offers a higher basis than a senior loan, but a lower basis than equity. Either mezzanine debt or preferred equity may be used as bridge financing. In the case that both are part of the project's total cap, mezzanine debt will be senior to the preferred equity. This financing tool bridges the senior debt and equity, typically accounting for between 5 and 20% of the total capitalization of real estate investment. Although mezzanine debt is typically subordinate to a senior loan, it is senior to all equity. The rate offered to mezzanine debt investors will vary depending on the loan to value. This is due to the associated risk levels equity investors carry compared to senior debt investments. Various types of mezzanine debt structures are used in leveraged buyouts. A capital stack involving mezzanine debt for private equity may include the following embedded options. So you might be asking, okay, how does mezzanine debt work? Simply put, mezzanine debt financing has a potential for strong risk-adjusted returns, particularly late in the cycle when common equity investments may carry a higher degree of risk. In down cycles, mezzanine debt may also offer attractive returns, as traditional lenders may tighten balance sheets, leaving quality real estate developers or sponsors more in need of bridge financing. It's important to note that property values tend to decline in down markets, but with mezzanine debt, investors are still likely to be covered due to the investment's low basis. The return potential of mezzanine debt may also depend on conditions in capital markets. The underwriting and leverage standards of traditional lenders may impact the market for mezzanine capital, and ultimately, this impacts the return potential of mezzanine debt investments. Mezzanine debt financing is potentially beneficial for accredited investors who work with a creditworthy sponsor and have a sound business plan. Primary benefits of investing in mezzanine debt include a generally higher rate of return, generally shorter hold periods, recourse in the case of default, and payment priority to all equity investors. For accredited investors, potential downsides of investing in mezzanine debt can include it having a capped upside, more risk than participating in a senior loan, and it can be difficult to access as an individual investor. The bottom line is that real estate mezzanine debt offers borrowers an alternative financing option that can potentially increase overall returns. Accredited investors interested in commercial real estate can take advantage of mezzanine debt in order to help finance large investments like multifamily real estate. Mezzanine debt positions may offer an attractive way to diversify from higher risk equity positions while maintaining healthy potential rates of return. At a time when inflation may eat into real returns of fixed rate investments, mezzanine debt can also provide an attractive alternative to treasury bonds and other fixed rate investments. Learn more about other equity financing options to start building your capital stack investment strategy today.